Welcome, everyone. So we're going to get into the next session. Our speakers are standing by, and this section is going to be looking at quantifying South African sovereign credit risk and arbitrage-free domestic credit spread estimation for South African government bonds, and that's presented by Jacques Bischoff, who is at the podium, and then we've got Terrell Moodley, and they're going to be doing something slightly different in the sense that as opposed to naturally taking questions at the end, they are open to questions in between their presentations. So if at any point you want to interrupt the more super difficult questions, you are more than welcome to do so. Over to you, Jacques.
Toots first. Okay, let me just hear my voice. Okay, yeah, that's a bit weird. All right, thank you everyone for joining this session. Did not expect so many people are interested in estimating sovereign credit risk, to be honest. So I think next time we'll have to ask for a bigger room when we do banking sessions. So yeah, I think this is slightly different to your general insurance type of sessions, I would say. Just a bit about myself quickly. I'm more of a banking guy, not an actuary by trade. So worked in a lot of credit risk and market risk spaces before. And currently I'm actually working a bit more in the general corporate actuarial space. Right, so let's go to our first little slide. And I'll just move over to this. Okay, Ty is going to take us through the context of why this is important. I guess the main thing that I think I want to highlight here is that the methodology is not novel. It is something that exists in the market. So a lot of the banking guys would know how this works, especially your investment banks. It's a quite an interesting methodology what we'll propose, and we'll show some interesting results that we found. And I think the key thing that I really want to highlight throughout the session is some of the limitations and some of the things that we can do to make this methodology even better. So Ty is going to take us through the context, and then, I'll take us through the methodology. Ty, over to you. Thanks, Rob.
Good morning, everyone. Thank you for taking the time to come and view this presentation. I know there were a lot of interesting concurrent sessions available. So I think we're going to start off this chat by defining what is actually sovereign credit risk. It's a term we're going to refer to a lot during this presentation. So let's start with national governments. And national governments require funding in order to invest in infrastructure, do social benefits, as well as just operate in general. So these funds can come in the form of tax revenue. They can come in the form of dividends from parastatals, if you're lucky, or borrowing from loans in terms of international bodies, such as the IMF, or by issuing T-bills, bonds, and other instruments on domestic or foreign markets. Now, any of these assets, as you'd know if you invest in stocks or bonds, bear some credit risk. Your counterparty can default, and national governments are no different. So they do have some benefits on their side in the terms of domestic currency in which they can kind of print themselves out of debt. But this has the consequence of inflation coming through. And other components to just keep in mind is sovereign immunity. So if a country defaults, you can't go into the country and take things away the way you would be able to do with normal, creditors. So sovereign credit risk, we define it as the risk that a government misses, restructures, or otherwise interferes with their obligation to make payments. And it's important to keep in mind that much like your normal rates and spreads that you would have, that the risk premium effectively captures this. So diving a bit into sovereign credit risk, we actually split into two distinct components, which is ability to pay and willingness to pay. So this point just emphasizes that even if a government has the money to make payments, for some reasons it might choose that it doesn't actually want to meet its debt obligations. And this can be due to prioritizing, for example, the domestic policy. They want to ensure that their people have sufficient interest rates and inflation is not too high and so on, and rather opt to default in this. So this risk premium that we described before actually covers both of these components. It's the market's perception of a sovereign's ability to pay as well as the sovereign's willingness to pay. So at this point, we've chatted a little about sovereign credit risk, and I guess the question is, how common is this event actually? And if we cast our eyes to Africa, actually not too sure why the map is not appearing there. But anyway, we did have a very beautiful map of Africa with some countries colored in. But in the last 10 years, we've had a few default events occur. One example is Mozambique, in which they actually hid some borrowing that was some borrowing from the IMF, which was one of their creditors, resulting in their debt getting restructured. The second is Zambia, in which they missed a Eurobond payment. And the third being Ghana quite recently in 2022, in which they just suspended most of their debt servicing. I think they recently came out of the debt restructuring in 2024. One event that's not on that slide is Ethiopia as well in 2023, which also recently defaulted, very similarly for not being able to meet a Eurobond coupon. It's also worth, and I actually realize I haven't described to you guys what a Eurobond is, and it's essentially any bond that is denominated in a foreign currency that in this case is issued by South Africa. So that would be a USD denominated bond or in euros. So the main question is, why does this matter for actuarial practice? If any of you are familiar with IFRS 17, they actually make reference to the yield curve having negligible and no credit risk in it. And in a case where you have events like this that occur in Africa, the question gets raised, is sovereign credit risk actually negligible in this event? If you're familiar with SAM or capital modeling, the PA actually prescribes the government bond curve as the risk-free rate. But if you're doing your own economic modeling and you're wary about the potential sovereign risk that's present in South Africa, that's something you might want to factor in. And if you want to be a bit more advanced, you can actually play around with the spread in order to do political instability modeling. A concept that is a bit more in Jacques' world is IFRS 13. But essentially, if you want to estimate exit prices or risk-neutral adjustments in a fair value world, this approach also assists. And then lastly, asset liability management, having a view of your credit spread just gives you a more holistic view and more factors to consider when considering your investment strategy. Perfect. So this now leads us to the case of South Africa and why we've chosen to discuss it today. South Africa has a fairly deep and liquid bond market with observable market prices available. But despite that, it is also rated BB minus by major credit rating agencies. What this means is that South Africa is sub-investment grade, which means that there is material risk worth quantifying from our perspective. In South Africa as well, there are observable what we call credit default swaps, which Jacques will chat about a bit later. But essentially, there are market observable measures for the sovereign credit risk, but one is that it is based in a foreign denominated currency, which isn't actually relevant to us and might have what we would call a quanta or additional considerations that we just need to look into before using that as a proxy, as well as credit ratings, but those are provided quite infrequently. As Jacques mentioned, this approach is not novel, but from our research, we have not found cases where this is actually demonstrated in the South African context, and this is where we feel our presentation adds value. For the remainder of the presentation, Jacques will take us through the existing toolkit for estimating sovereign credit risk, discuss the methodology that we have applied in the paper that accompanies this presentation in more detail, and then Jacques and myself will just discuss the results. And on the right of that slide is where we're building towards. So when we get into the results section, hopefully we'll have the tools in order to unpack what's happening there in a bit more detail.
Cool. Thanks, Ty. Maybe just to expand a bit more on this little graph here. So essentially what this is a time series of a credit spread that we bootstrapped. There's also a different measure which we call delta, which we'll introduce a bit later. And then the red line, which is the top line, is SOAF CDS spread, which is quoted in USD. So you can see that's obviously significantly higher than comparable to something that's in domestic currency. And for that specific reason, it's important to be able to strip out and understand the sovereign credit, but based in domestic currency. And there's various reasons when that is really important. Right. So before we jump into the model that we've used, we'll quickly just highlight and discuss 5 methods that's generally acceptable in the market. So the first approach is a structured model type. And, so you can use Merton model for this. I've seen it before in practice, but not necessarily on sovereigns. It's really difficult to do. The core foundation of this model is that you need to assume or need to understand what the balance sheet value is, right? That's quite hard to estimate for a sovereign. But this methodology essentially assumes that it's a callable type of option. And then when your debt or your assets drop below your debt obligations, that's considered some sort of a default, right? Another point here is that you would also need to calculate or estimate some volatility parameter, which becomes really hard to do for sovereigns. So this is, I would say, a better approach to use on corporates. The next one is a reduced form model. This is the core type of structure that we will use in our approach, And this approach assumes an intensity of default, right? And what's lovely about this approach is we can apply this on almost any debt. It's not necessarily just for sovereign, and I'll give you a couple of examples where exactly our methodology we can apply to FRNs that's listed on the JSE file. And we can strip out credit to understand the credit for that specific corporate entity. Then the other 3 to just quickly discuss is there's a hybrid model, becomes really complicated in this regard. This is a mix between the Merton model and the intensity model. Then credit ratings, that's obviously, I think, probably one of the most used and widely acceptable approaches. The problem with credit ratings, especially on sovereigns, is it's not really reactive. But I think it does serve a fantastic benchmark and baseline to use in your modeling approaches. And then, lastly is named CDSs, right? So South Africa is known for not having a liquid market in CDSs. And if there's a liquid CDS for a specific named counterparty, so for instance the SOAF, unfortunately that's not quoted in Rand, right? So it's quoted in USD. And what that almost bakes into the price itself, it's not just peer credit. I don't know if anyone can hazard a guess like why there's a Quanto. So what is the guys pricing extra into a CDS? It's an interesting thing. So when we refer to a Quanto, is that there's a correlation between your FX rate and the default of that entity. So if you can think about it, if South Africa were to default on its obligations, debt obligations, something will happen with the FX rate. If Vodacom defaults on their debt, nothing's probably going to happen. So that's a really hard part to strip out when you have a CDS. A different approach to use is something called benchmark or consensus quotes from a CDS market. So Mark IT actually does provide a lot of consensus quotes, which can be useful. A problem with that is that, again, it's not necessarily specific to a named counterparty. You'll have to do some smoothing because it's basically a whole bunch of market information dumped into a file, and you need to sort out how you're going to use that. Right, so our methodology. I'll describe this in a couple of steps. As I mentioned, it's part of the reduced form. So we're going to assume a hazard rate type of function, and I'll get to that when we get to the pricing equation that we'll use. The first little step that we need to do is we need to assume a subset of instruments. So in our case, what we've used is we've looked at what the JSE use as their constituents when stripping the Gavi curve, so the nominal bond curve, if you're familiar with that. And we've excluded all the treasury bills in the start. We've only used the bonds, right? So we've got our R186 all the way to, what's that, R2048, right? So these are a bunch of bonds. You can find the contract specifications, on the JSE site. We've got semi-annual coupons, and then what we have is a price, right? So this price is the fair valuation at a specific point in time, right? So for the purpose of this presentation, we will do this on 30 April, and that value that we see, the all-in price, embeds not just, it's not just the value of, the cash flows, but it actually embeds credit, liquidity, in other risk premiums in there. And that's essentially what we're going to do, is we're going to try to divide what is credit and what is not credit. And then later on in the results, we'll show a methodology on how we can potentially, if you have bid-ask quotes, how to strip out liquidity using the same approach. So yeah, I think that's a quite a unique methodology. But I think to generalize this, if you want to apply this on a corporate bond type of portfolio, step one, select a subset of bonds, and they need to have various maturity dates into the future. Step two, verify you can actually value that bond. So what we've done here is we took the Govie curve from the JSE, right? And then we did a discounted cash flow for all of the bonds. This little table here it's just an example of the first bond and how we've net present valued that essential cash flows. So we're actually not going to use the Govie curve in our bootstrap because we're going to assume a new benchmark curve. But this is just really a validation step. Are your cash flows set up properly? Because the cash flows underpin the full process, right? So you need to do this now for all of your bonds. I think this one is probably the only one. If we just quickly go to the next slide, here we've just got a comparison between the JSE all-in price. It's a dirty price, so it includes the accrued interest, and then our DCF value using the JSE's curve, the Govie curve. You can see there's some minor differences. I mean, if you can get exactly to what the JSE produced, then hats off to you. Yeah, I've never been able to do that in 8 years working with this stuff. I think the JSE applies a slightly different methodology here and there. It might be interpolation, but as a previous auditor of investment banks, I would say that is reasonable. Right, so the next step is set your pricing equation and assumptions. Now, as actuaries, looking at some of the standards, I just got away from a session that Ron presented and everything I'm lost, basically. And there's so many assumptions that you can make, right? Hopefully in this, there's not that many, but I'll also discuss some of the limitations to some of the assumptions that we do make. So what we'll do here, essentially, is we want to take the cash flows that we've pre-calculated, and we want to divide them into two main groups. So the first state is what we'll call the survival term. So the survival term is on condition that this bond survives, there's no default at that point in time, these are the cash flows. Then the second term is on the event of a default, what can we recover post-default, right? Now, the main concept here is that if we assume that the market is priced in credit in that all-in price, and that all-in price is available because it's a listed instrument, we can now use this formula to strip out credit. Now, I guess the next question is, okay, well, how do you estimate recoveries? We'll make an assumption. The second thing is, what do we use to discount, right? And this is where we start to introduce the concept of a risk-free curve, right? Now, there's no such thing as a risk-free curve, technically. That's really purely theoretical, doesn't exist. But we've got good proxies, and we will use the JSE swap curve as our risk-free curve. And I will discuss some of the limitations, using that assumption in a couple of slides. But I guess that is probably one of the better assumptions that we can make. If you've heard of Zaronia, that might be a better assumption to use once that is live, properly live and liquid, then we can use that. But I don't think that would materially change our results. So yeah, we've just went for the swap curve. Right, so this is just a little picture of the curve. You can see the orange line is the Govey curve, and the blue line is the swap curve. There's quite a big spread between them, and this is what we'll refer to as the delta, right? And what I will show is that in our pricing equation assumption, if we assume that LGD is 100%, right, then technically, because that last term was recovery, so then we recover nothing, that term falls away, then essentially what will land up is that our methodology will basically estimate the delta between these two. So that's a good sense check that the methodology is working. Okay, we'll just skip over those quickly. All right, so from the pricing assumptions, right, so and this is where I wanted to get to from I guess your main assumption here on the risk-free curve. Firstly, we are in a bond market. We're going to use bond prices, but we're going to use a swap market curve as our risk-free curve. That is technically fundamentally flawed. So, and I think the swap curve is quoted and built out of the 3-month JIBARs. So FRAs and swaps. So it's fundamentally different markets, right? So technically we can't use that. So Zaronia would probably be better. It would remove the bank credit and term premium from the curve, but we're still in 2 different markets. The better alternative would be to use a repo curve. Now, I don't have a bank, I don't own a bank, I don't trade repos, so I don't have access to that information, so we can't actually strip our own repo curve. But if you have a repo curve, that would be a better assumption to use. Some idea that we've been toying with is that if Zaronia is live, can we, for instance, maybe partner with a bank to understand some of the repo transactions and calibrate a factor adjustment that we can apply on top of a Zaronia curve to essentially proxy the repo curve? Because once you have a repo curve, the other problem that you have is you don't have a long-dated repos. It's really overnight type of transactions. Some cases, 6 months, probably max a year. So, and we're trying to estimate credit maybe for 10 years. So it just introduces another problem as well. All right, so now we need to actually calculate credit, right? So we've got our pricing equation, we've set our assumptions, we've used the 60% LGD in all of our results. We'll show the 100% LGD as well, just to show that it comes back to the delta process of the 2 curves. But I guess the main concept here is that this is a recursive bootstrap. Now, what I mean with recursive is that it's similar to how you would strip a yield curve, right? So you've got a bunch of instruments. We would essentially solve the first part of the curve. We'll move to the next part. We'll solve the next part. But the information that we've solved in the preceding step we'll use in the second step, right? So that's what we refer to recursive. So in this little timeline here from the solving type of equation, we would first solve the hazard rate on the R186. And then after that, we'll use that hazard rate between the times from our valuation date until that maturity date. And then we'll solve a new hazard rate, right? And then the reason why this is really important is because if we, once we have all the hazard rates, we basically get back to a single curve of credit. And this can reprice all our bonds at the same time. And that's the idea. You don't want many credit curves, right? You want one that can reprice everything. All right, so there's just a little formula on what survival means. But yeah, it's basically, we're going to take our preceding survival times the exponential or your exponential function of your lambda. So lambda is the hazard rate we're solving times the delta time. So that's the time increments we're moving forward in all of the subsequent cash flows. So that sounded very foreign, and if I lost you, I'm sorry, here's a little table which hopefully represents this. So this is the second bond, right? So we're looking at the R2030 in this cash flow. So this is the survival term that we've solved. So what you'll see here is that, wait, let me just put the laser on quickly. So this little piece here, this is the hazard rate we've solved in the initial step, right? Then what we need to do when we're solving for our second hazard rate, we're going to keep that fixed, and then we're going to solve for this one. So this is already the pre-solved answer for this specific time step and the cash flows. But what you can see here is that we essentially have a constant hazard rate. So our assumption is a piecewise constant. We keep the hazard rate constant over time between the various nodes. But that does not mean that your survival remains constant, because it's got that time factor adjustment in there. And I have mentioned why this is necessary, because if we don't do this, we won't be able to take a single survival curve and reprice back all our bonds that we initially set. All right, so this is the split up between the survival term and the default term. So essentially what we show here is that we solved back, so the difference there is the difference between our original DCF calculation that I showed in some of the couple of slides ago. But we've now separated that all in value into two components. So we can clearly show that we could reprice back all the bonds that we selected, and we clearly divided the two. Something that's quite interesting here, and you'll see it as an artifact in our results here, is that if we look at the R209, there was a little kink in the curve. I don't know if you guys noticed that on the Gavi curve for this specific validation date. We'll show it again. But you'll notice there that if you just look at the default percentage as a percentage of the total fair value, there's a 12%, and then it drops again to 11, then 13, 15, 16. If you plot this, it's very linear. You can also apply constraints in our process to constrain these type of outliers. But this is quite an interesting artifact that caused some interesting discussions between Ty and myself during our results. Actually wished I chose a different date, but unfortunately I compiled all the graphs and then we only had the discussion afterwards. So this is then the final result from the bootstrap, and we'll show some nice graphs that illustrates this a bit better. But what we have is we've got a term structure, for instance, a forward tenor, right? We've got a survival curve. We know how to interpolate that because we've got the piecewise constant hazard rate between all the various nodes. So we just keep that flat, and we can interpolate and extrapolate. We also have the conversion to a zero hazard rate. So what that is essentially is it's the intensity of default from time zero, your valuation date, all the way to that specific point in time. But that's not actually what we solved. We solved for the piecewise hazard rate. So you can see that does increase quite significantly all the way to 2049. And then there's some very basic mathematics we can do to basically just convert this into a credit spread, which I will show the math just now. All right, so yeah, let's maybe look at some graphs, some fancy results.
Before that, I think, is there any burning questions that the audience has? I think we just want to ensure that. Sure thing, go ahead.
Thanks. You mentioned earlier that you wanted to strip out the liquidity kind of from the swap curve to the bond curve. It's not just credit risk. So far, it looks like you've just stripped out the whole gap delta as credit risk. Is that right?
Yeah, okay, so that's a very good point. So what we've assumed in our process is that the price or the prices from the JSE, the all-in price, is more or less, we can almost approximate that to a frictionless market. So it's not your tail on your bid asks, right? So at the end of the presentation, we'll show an example. If we have bid ask spreads, how can we then approximate the liquidity? So currently, we would essentially say that there is probably liquidity baked into this, but we assume that it's all credit because in our methodology, we assume that that price is your mid price or the close approximation to a frictionless market. So yes, it is probably not the best assumption, but yeah, I guess there's no real other alternative.
Any other takers?
Got a question right at the back, so if you could just keep your hand up, we'll get a microphone to you.
I was like...
Thank you very much. Question is about the term premium. You did mention term premium in the swap curve, but are you essentially assuming that the term premium in the swap and bond curves are identical?
So, yeah, like I don't think necessarily that we assume that they're identical. I think what we're saying is that we are aware that there's bank credit and term premium in the swap curve itself, right? Because that's currently how the market works with JIBAR. Once the sensation of JIBAR falls away, hopefully this won't be a problem and we don't have to discuss this point. But we're not assuming that they're identical. Essentially what we're assuming is that the credit or the price, essentially, in the JSE all-in price, right, embeds credit and liquidity, and that's what we want to strip out. But yeah, we haven't made any assumptions that the markets are exactly the same. And yeah, I guess maybe just to refer back to that original point, if you had a repo curve, right, which is then in the bond market, and that would have been seen as your complete risk-free curve in a bond market, that would have been a much better assumption.
Okay, thanks.
And we have another here in the front.
Oh, yeah. Yes, I had to open my Chad Alt Pro account here on the side to answer these questions.
Thank you so much. The session is very informative so far, but you mentioned the cessation of JIBAR. I just wanted to find out, since the credit adjustment spread is going to be explicit between, when when the cessation happens and when Zeronia is introduced, does having the CAS explicit make your investigation easier, given that Zeronia is now not going to have that implicitly built in? And also, how are you going to deal with the forward-looking nature of JIBAR in comparison to the backward-looking nature of Zeronia? I think that's quite interesting and how that'll impact your investigation.
So I don't know if everyone got that. I think the first question is on the sensation of JIBAR. So yeah, I think that would actually make the process much easier. Because if we have a Zeronia curve, right, we know the characteristics underpinning that specific curve, right? It's obviously not prone to any manipulation from banks. I know obviously JIBAR hasn't been manipulated like our LIBOR counterparts. Go read up on some of the penalties some of the banks paid. I'm not aware of any, at least. But yeah, I think it would make the process much easier because I think we would better understand the characteristics, right? It's an overnight rate, but there will still be Zeronia swaps issued, right? And that is what the market will use to inform the forward rate. So Zeronia is quoted as an overnight rate now, right? But the market will trade Zeronia swaps. And that is what you will use to also build out a Zeronia curve. So the concept of a curve doesn't fall away. We will still have that. Unfortunately, we currently only have quotes of Zeronia daily. You can go check them out on the SARB. They actually backdated it all the way to 2016, I think, as well. So you can actually go compare that with your JIBAR. I've actually done quite an interesting analysis where to essentially calculate that credit adjustment spread, which sits around, I think, 30, 40 basis points currently on the 3-month JIBAR, which is where the liquidity sits in the market. It's quite an interesting methodology. I've done exactly the same as what Bloomberg did for the LIBOR process and the SOFR comparisons. But yeah, to answer your question, we will still have a Zoronia curve. The banks will obviously build liquidity in those type of instruments, and then we can use the same methodology. Right, Ty, let's look at a graph. I will do this and you can chat.
Perfect. So just to start off here, we did show this graph a bit at the beginning of the presentation, and a lot of math has followed. But the main points I just want to highlight is the SOAF curve, which is actually USD-denominated SA government bonds, and that's that CDS spread that we mentioned is observable in the market that you can view. An interesting point to highlight, though, and we've mentioned this idea for Quanto, and Jacques gone into it in terms of devaluation risk, is that difference between the SOAF curve and what we've considered delta, which again, just going back, is the difference between the swap curve and the government bond curve. So we can see it trades almost at 150 basis points at some points, which if you're using that as an estimate and you're not accounting for it appropriately, can lead to some issues in valuations. I would like to then draw your focus down to those two bottom graphs, orange and blue, if it shows on the presentation that way. And essentially that orange curve is what we have calibrated as part of our research paper. In general, what you're viewing in this plot is 5-year spreads at each specific valuation date. So you're seeing a timeline of these spreads over time. And notably, in 2020, you see the impact of COVID come in. So COVID happens, massive risk and panic in the world. South Africa's sovereign status feels a bit more sketchy, and you see that massive uplift from that point onwards. And interestingly enough, after that 2020 point, the curve doesn't really drop down back to the levels that we had observed before. If we then look at the orange and blue, around that 2022 to 2024 portion, we notice some deviation in the curves. And this comes back into those two legs that Jacques spoke about in terms of your survival and default legs in the pricing. And it is important to note here that this assumption we've made around loss given default is 60%. We do have a slide, a few slides later, where we show some of the sensitivity around that loss given default assumption. But that difference is driven by that amount. Earlier on and around that, you'll see some noise where the blue and orange lines go up and down relative to each other. But that massive difference between 22 and 24 is effectively your default probability difference between your calibrated credit spread and the delta. Anything you'd like to add?
Yeah, maybe just lastly, right, so we'll show that, I think, let me just move to the next slide. So this is the delta curve, right? So remember when I showed the original two curves? This is just the difference. Here we've assumed LGD of 100% and then calculated the credit spread. So what we get back to is the blue line, and that approximates that delta almost exactly. And your question probably would be, okay, well, why is it flat at the start? And that is just our first maturity of the bond that we've used, right? So we don't have any T-bills in our process initially. So we will have a piecewise constant or flat hazard rate initially until our first maturity of the first bond. So it won't approximate the start of the curve well, or the deltas well, but you can see that it does pick up basically the full shape. And there around 2036, you'll see that little dip, right? And this caused some issues when changing LGDs in the results, and some funny behaviors post, I would say, the 10, 15-year mark, 10 is on the curve. Right, so this little graph here is just a visual representation of the piecewise constant hazard rates, and then also the credit spread. So this is what I originally showed in the other table when we discussed the methodology. So yeah, I guess what you can see here is that, and this is what we refer to, the piecewise constant, is that it will remain constant between those two nodes, right, of maturity. But again, I think a key takeaway really is that it doesn't mean that your survival is constant over time. And then we've just plotted the credit spread, and you can see that that also increases. Maybe just going back one slide to this little graph, I just want to note that the red line is USD SOAF CDSs, right, as Ty mentioned, and that is essentially quoted as a par spread, where our curves are zero spreads from the 5-year point onwards. So they're not 100% comparable at this point here. To actually change this or have an exact like-for-like, we technically would have had to take the CDS and strip that out into a hazard rate, survival, and then change that to a credit spread. But yeah, I think there's a good approximation. It won't really change the view too much, but you might see some funny kinks here and there. That's not exactly comparable.
While Jacques just heads into the next slide, another point to mention is that all of these slides following are all at the valuation date of the April. So these are looking at a specific valuation date going forward, whereas that first graph that we showed you was looking at different valuation dates between 2019 and 2025 in order to just give you a view of the time lapse.
Yeah. Yeah, so once we have hazard rates, we can calculate survival curves. So I'm a XVA guy. I don't know if there's any XVA guys in the room, if you've ever heard of it. No one? Okay. Right, so that's where you use survival curves in the market. So if you think about this, right, so I just want to put out a topic on where we can potentially use this in the fair valuation discussion that Ty mentioned initially, is that if I have a, let's say, interest rate derivative portfolio with our lovely Eskom, we can essentially say that we can approximate their credit using the government because it's a SOE. We can use exactly this approach. If all the derivatives are based in Rand and it's based out of a Rand funding pool, then we can basically just use this survival curve as is. Obviously, noting the limitations on our assumptions that we've made on the risk-free curve. So this is where things went wild. So if we look at this, right, and maybe there's someone in the audience that wants to comment on this, but it doesn't actually make sense if you look at this graph. So what you'll see at the top is the little light blue line, LGD 60%. And then as we increase LGD, right, technically we're getting a lower credit spread. It actually doesn't make too much sense. I've investigated this in a lot of detail. It's not an artifact of the methodology or a process error in our approach. It's really that small little kink in the graph. So that little kink. So that's the R209 bond was potentially mispriced in the market at this point in time. To fix this was a lot of work because technically what you have to do is remove that bond out of our selected subset. But then what we have to do is we have to go strip the Govey curve. So now we can't use the JSE curve anymore because they've included that constituent in their curve and then go through the full process. And then if you 12 hours later still see the same issue, I don't know, go buy tequila. All right, so I think we've discussed this graph quite in a lot of detail. This is quite a nice animation. So this is the term structure of the CDS, or not the CDS, the credit spreads, and we're moving over time. So you'll see we're going to hit COVID now, and the entire thing just jumps up significantly, especially in the long tail. And that is really a key thing from, I would say, the uncertainty in, I would say, post your 10, 20-year events, right? A key takeaway from this is that this methodology that we've just discussed on a single date, we've basically done monthly from 2016 all the way to now, right? And that is what that little animation represented. You can see how it moves over time. It's relatively stable month to month, but you do get some spikes. Unfortunately, if you do this over a massive time series, you won't be able to investigate all those small little kinks and issues and nuances as well. So this is really just, I'm 80% confident it's right. But yeah, it looks reasonable, again, from an auditor point of view. Any questions on this graph?
Let's do the liquidity and then we can.
Yeah.
Perfect.
So Ty's quickly going to take us through the process for liquidity. I'm also not 100% sure that this is something we can do in the market. It's really dependent on bid-ask prices, but I think probably better to use this on corporate debt. But yeah, we'll quickly just discuss the methodology related to this.
Thanks, Jacques. So yeah, as Jacques alluded to, we did start off by also saying we would discuss a little bit about a liquidity extension to this paper. And as Jacques mentioned, getting bid and ask values on the market was quite difficult. So what we've done in order to illustrate how this methodology could be extended is assume a hypothetical spread around your mid price. So those ask and bid prices are purely fictional. In the paper, you'll actually see two different cases where there's a smaller spread around one, and around the second scenario, we effectively double the spread just to show the differences. And what we essentially do is perform the same methodology on just your bid, just your ask, and just your mid prices in order to get three calibrated curves. And you'll notice a sort of envelope boundary around that mid orange curve. And that boundary also expands as time increases. So very similar sort of view is observed if you look at scenario 2 in the research paper. But effectively, you could calculate liquidity as the difference between the mid to bid, the mid to ask, or half of the difference between bid to ask. So again, we haven't tested this on actual data, but we just wanted to illustrate what was possible as an extension. Perfect. I think that takes us to the conclusion. It leaves us about 11 minutes left for questions. But just to recap quite quickly, the actuarial applications were discussed around IFRS 17 as well as the IFRS 13 valuations. We believe that this method is operationally simple. It provides an auditable procedure for exact price reproduction. And then, as Jacques alluded to during this presentation as well, there are extensions that can be conducted to this paper in terms of applying Zeronia instead once it's liquid, as well as using benchmark piecewise constant hazard rates instead of the bucket ones that we've used. Perfect. Jacques, would you like to add anything?
Yeah, maybe the last thing that I would like to add before we go to questions is that I've seen this methodology used in industry. It's not just a thumb suck. So the banks are actually using this. So if you're working at a bank, you probably in an investment bank, you probably know of this. I don't know. It's useful for pricing as well. So if you think about emerging markets, right? So if we think about some of our counterparts a bit north, up in Africa, it's really hard to estimate credit. And usually what the banks need to do is they need to provide funding. For South Africa, banks would probably need to provide funding. And they need to essentially price what that funding would be. So, going through their whole FTP process where they've got a treasury function, they know how to fund internally, but they want to essentially add a load premium for sovereign credit. This can be a useful approach, right? Again, the underlying assumption would then be that there's some information in the market. So yeah, if we're dealing with Nigeria, I don't think this is going to work. The market there is just stuffed at the moment. But yeah, I think this is really extendable. I've also used this in corporate debt estimation. So for instance, if you have a counterparty in the industry, and they've got listed information, and you want to price a deal for another counterparty that's in a similar industry, but they don't have listed debt, we can approximate it and just do a fancy write-up and say why it's reasonable. Yeah, so I think that concludes our session. yeah, I don't know if there's any other questions. We can revisit some of the graphs. I'm happy to take them. If it's too difficult,
Thanks.
I will walk away.
So I've got a question this side before we go to the floor. You mentioned, just out of interest, the CDS is trading in foreign currency. If you rebuild the portfolio using the same derivatives in foreign currency and hedge out the currency experience or exposure, would that be a fair assumption that that's the implied credit default price by market accounting for currency?
So not exactly. So essentially what will happen in the CDS market, so if we look at the SOF spread, right? So that prices in a contagion risk or a devaluation, currency devaluation risk in the CDS, right? And then probably some profit, right? So it's not purely credit on our sovereign, and that's what makes it really difficult. Unless you are a bank that can get consensus Quanto quotes, so there's actually a market on Quanto, then yeah, it's definitely not observable. So really hard to estimate. You can, if I think maybe a counter argument to what I've just said is that if you have the USD and you have the rating of the sovereign, and you've got a rating-based CDS, right, which will inherently never have a Quanto because it's agnostic of country and currency, then you can basically infer a Quanto. And then from there, you can take the CDS and then strip out the Quanto. But that's probably a bit more work and probably prone to more error as well, and same type of assumptions.
Thanks.
Okay, thanks, guys. That was super interesting. And you said all of this. Over here. We go.
Oh, sorry.
The USD CDS, obviously there's more going on there. That's not a straight comparison. The stock market and the bond market, you said they're different markets. There's not going to be perfect arbitrage between those two. But I was still surprised that from about 2021 onwards, just eyeballing those two graphs, the correlation there is kind of nothing. Before then, COVID, everything moving massively together. So I'm not sure if there's a question in here or just a comment. What do you think the reason is that we're getting so little relationship between these two measures that are measuring different things, but still similar things over several years?
Yeah, I think it's definitely it's a good observation. Very hard to answer. We'll ask ChatGPT after the session, but I guess the problem here is that your Quanto is also not static over time, right? So the perception or how the market prices in currency devaluation. So I mean, I'm not sure what the rand dollar is trading at today, but it's much better compared to a year or two ago, right? So the Quanto baked into that process will also change. It's really hard for me to give you a concise answer because I can't access Quanto quotes. But yeah, I think the other reason that they're probably quite hard to track exactly is because one is a par spread, so it's the actual spread that you're looking at from the CDS contract itself, whereas ours is a zero rate, right? So it's basically you can use that to discount. So yeah, maybe if we do a comparison like for like, again, it's hard because now I need to then strip all those on the USD side and get all those SOFR curves and whatever. But maybe it would have been a bit better if we look at the graphs. But yeah, it's a good observation.
Thank you for an interesting presentation. You mentioned the potential application for some of the economies north of South Africa. But I mean, typically market information is really a restriction. I mean, one of your primary dependencies was having a swap curve, to use for as risk-free, and also the availability of deep and liquid, even government bonds. So have you given consideration just practically how you would apply that, or yeah, that for outside?
So in markets, not South African markets, other emerging markets.
So for example, Ghana, Egypt.
Yeah. So again, you guys are asking me difficult questions here. I'm not one of those black balls with just all the answers. It's really hard to estimate. The market there is wild, right? So there's probably, if there's something observable, it's probably not liquid, firstly, so you can't actually use it. Something that I've been toying with, and I haven't developed it, it's just a concept that I want to think about, is that if we have a market like South Africa, which, you know, from a financial point of view, there's actually quite a lot of volume, right? If we can apply or do some, I'm going to throw out the term machine learning, on I would say, your more global markets, and try to understand some factors, right? And then do some transfer learning from those markets to emerging markets to adjust those factors to rebase that to a Zoronia type of benchmark. That might be a possible solution. I don't think the auditors are going to like that. But again, pricing, you will get away with it. But really, yeah, I mean, if there's no liquid market, very hard.
Yeah, no, thanks, I agree. And if you solve it, inverted commas, please present at the next
Will do.
convention. Thanks.
If there's anyone that wants to invest in that opportunity, you're more than welcome to meet me afterwards.
And we've got a hand up here. Oh, we've got, okay, so let's come here, and then I do see you over there. Perfect.
Thanks, gentlemen. I just wanted to actually make a comment on the reason for the difference between the swap curve and the bond curve, and why I think actually that it's kind of fundamentally you can't look at the credit risk based on that difference. And the reason is because the swap curve is an unfunded curve. In order to get that return, you don't need to put up any money up front. You just pay the interest differential between JIBAR and the fixed rate every 3 months. But the bond curve, you've got to put up a lot of money up front, and that liquidity means that there's a much higher premium that you've got to get for that. So that probably explains the vast majority of that difference rather than credit risk, and which is logical because there's actually bank credit risk in all the swaps. And you wouldn't, if they were both unfunded, you'd expect the swap curve to be higher because banks have higher credit risk than sovereigns generally. That might not be the case here. And then just the other reason is, of course, there's supply and demand factors that, for example, that will push down the swap curve further and further that delta. For example, pension funds wanting to increase duration for de-risking. And so it's just two comments on why actually that spread might have very little to do with credit risk of the sovereign.
So, yeah, I mean, valid remarks. And I think that's why we added it into the presentation. I think it's currently a fundamental flaw. If we had a repo curve, we probably would have landed with a much better result. So on top of my head, I've looked at some of the credit spreads that we've estimated using this approach and benchmarked that with the original pricing of a first-rand CLN that they've basically entered into backing the R2037. And obviously they would load some profit in there. There's other factors that drive it. But I don't think we were like materially out. Again, it's a good approximation. I don't necessarily say that this is pure credit and it's the golden source to use. But I mean, if there's no alternatives to use, then at least this is a good approximation. My view, my opinion.
Okay, so over there, right at the back, I think you had a hand up. There was a microphone that moved to you. Yes, no, maybe?
Basically, there's a similar question to that one, and I was going to suggest for further research, you perhaps try and estimate the component that comes from the differential between the two curves from funding versus credit. And then maybe just a comment on the R213 bond, the 2036, as well as the R214. Those were bonds that were issued a lot longer ago with much lower coupons and possibly higher convexity and duration than some of the more recent issued bonds. So, they are also held a lot more by foreigners compared to locals, and therefore they do seem to show a lot of distortion to the curve, possibly not only at that date, probably at a lot of other dates as well.
Yeah, no, I think I tried to go back to a couple of months because that's where I had data and I couldn't find find a new valuation date where we didn't see that little artifact in the curve. But again, it's that whole recursive nature when we solve the hazard rate that basically pulls through the full process. So again, there's probably some key limitations and problems with the results at the end of the day. I'm not going to say that this is what you need to use to price, but I mean, if we look at those little, let me just go back to our little visualization. So if we look at this little visualization, I mean, this is pretty on par to what banks would quote for sovereign credit, more or less. So I think there's a good benchmark to this. Again, I think if you have all the data, if you run a trading desk and you've got more information, you can probably do this much better. You can use the same methodology, but you'll have better information to drive as your inputs.
With that, I do believe we are out of time. Thank you, gentlemen, for the presentation and the engaging session, and thanks for all the questions. There is a feature on the app that I am asked to encourage you guys to use, which is Beyond Connect. It's on the social wall, so if you don't socialize in person, at least socialize on the app. Cheers.
So we will meet back here in an hour at exactly 13:40. So lunch today is sponsored by Africa Reinsurance. So thank you so much for those of you who are here.
Cool. Thanks all.